Let's touch base with our next guest this afternoon, and we have Ganeshram Jayaraman joining us with his perspective on the markets. Ganesh, it's great to have you on the show. Thanks very much for taking out the time. You're expecting higher earnings, you and pretty much the rest of the market. But where will that earnings momentum come from? We've seen in IIT, TCS as well as Infy come out with a set of numbers that were pretty decent. HUL has come out with a good set of earnings. We are waiting Z Entertainment's numbers, and then of course, the large private banks will start rolling out. Is it really the predictable few where the earnings growth momentum will stay? When is it that you're likely to see the investment cycle-led earnings pick up come through?
Hi, good afternoon. I think it's going to be a very mixed picture on earnings. There are sectors, and within sectors there are companies who will report a far better earnings profile vis-a-vis others, and it all boils down to pricing power. And because what we are seeing in India currently is a lot of changes to the earnings profile vis-a-vis the last 4 years. We had a phase of muted inflation, commodity prices, rupee appreciation, all of which led to gross margins, net interest margins for financials looking much more than historical average, and that is now going to taper off. So you are going to see a phase where gross margins, EBITDA margins will be under pressure, and it is really a test of which company is able to pass it on far better, and that's not vast majority. In fact, we believe that just about maybe 15% of the companies will be able to hold on to their gross margins or EBITDA margin profile vis-a-vis the last 3-4 years. Many others will see that begin to begin to wear off. Talking about the investment cycle, which you said, I think it's still a long way away. When you look at asset turnover of companies, when you're looking at the capacity utilization levels, when you're looking at the levels at which companies tend to start planning for capex, we think that's still some time away, at least 12 to 18 months away, and which means we are not going to see it in fiscal 19-20. Maybe the election outcome in May 19 could be the trigger for the next 6 months after that, where some political stability might push companies to start planning. But when you look at numbers today, when you look at the kind of historical triggers which have brought in capex, that is some time away. What has also happened in this phase is the NCLT mechanism has also added some capacity into the system. Each sector, rather the core sectors, steel, cement, power, to a lesser extent in power, but what's also happened is that's brought in capacity which was at the sidelines, low utilization levels. Given that there is some amount of delay in companies' mindset to plan for capex, so that's not going to happen anytime in a hurry. At the same time, we are seeing some signs of headwinds come, and it's all boils down to pricing power. What we call them all-weather managements, all-weather companies which have a track record of delivering historically vis-a-vis not just in up cycles but across cycles.
Okay, fair point.